everybody. Rebecca Steinhaus here with RE/MAX Services. We're here at our buyer's console area. I'm with my friend Craig Stelzer with Cross Country Mortgage, and we're here to answer some of your mortgage questions. So, Craig, how are you today?
Hello, Rebecca. Thank you for having me.
You're welcome. So the first thing a lot of people have questions about, so when you go to look for a house, when you're a buyer, we always recommend you be pre-qualified. So one of our questions is, how long does it take to get pre-qualified? What information does a buyer need? Do they have to do any homework to get pre-qualified? How does the process work?
Sure, no problem. Yeah, great questions. These are things that, we preach on our end, where when people are getting pre-approved, it's very important that we look at their last couple of years of documentation. So specifically, we'll look at 2 years of W-2, 2 years of tax returns, a couple of pay stubs. Oftentimes people will say they don't have that because maybe they were in school and this is their first year on a job. So there's extenuating circumstances. Generally speaking, rule of twos. 2 pay stubs, 2 tax returns, 2 W-2s, a couple bank statements. The process itself can be as quick as our clients can make it. And so on our side, generally we review stuff within a few hours. But oftentimes, people might not have thought they were going to get pre-approved, and so it takes them a little time to gather information.
That makes sense.
Mm-hmm.
That's awesome. So rule of twos. Always remember rule of twos. The next question is, so when people go and qualify their loans, what are some of the loans they can qualify? We know there's FHA, conventional, VA.
Sure.
You go a little further on that?
Yeah, absolutely. So typically the type of loan that someone will get will depend on their overall goals and overall credit profile. Generally speaking, VA is for people with, of course, military benefits, but that want to put down a low down payment.
And
so,
with the VA,
mm-hmm.
I actually just did a closing with my uncle, who mm-hmm. was a veteran. He wasn't aware of that you had to put a down payment, but when you are a veteran, you can put, how low of a down payment can you put?
So if the loan itself is under, or the sales price in Florida is under $453,000,
mm-hmm.
You can do a no money down.
Oh, you can?
You could do 100% financing. There's still mm-hmm. closing costs, but
right.
It's 100% financing. Every dollar over a $453,000 amount, the veteran has to put down 25% of. So it's 25% of every dollar above $453,000. You can do $1 million VA loan. So oftentimes when folks are applying with us for jumbo loans, mm-hmm. one of the first questions I ask is if they have a VA benefit. And so a lot of people don't realize that that benefit is out there, and if they do, they'll get below market rates compared mm-hmm. to conventional loans with a lower down payment requirement if they choose to do it. Mm-hmm. So it's a terrific program, yeah. Great benefit. And really doesn't.
My brother is looking forward to using his too in a few years. Yeah.
The VA is a tremendous benefit to our service folks. Mm-hmm. Conventional loans are more your standard, higher credit profile borrowers. About 80%, 75-80% of the loans we do tend to be conventional. Mm-hmm. Those can be anywhere from 3% down, all the way to people can put down as much as they like, right?
Yeah. So conventional private.
Generally speaking, when people tell you they want to do an 80-20 or 20% down, that's a conventional mm-hmm. mortgage. There are some great first-time buyer programs with 3% down. 5% down is very common with conventional lending. Okay, so your conventional loans by definition are things that, or loans that are backed by Fannie Mae or Freddie Mac. Mm-hmm. That's the definition of a conventional mortgage.
Okay.
And the limit that the government set forth for this year is $453,100. So anything under $453,100 can be a conventional mortgage. Oh. Anything above $453,100 winds up being a jumbo, or like we talked about, a VA potentially.
I didn't know that.
Yeah, it's sort of an innocuous number. I don't know why but
weird.
They go up every. Yeah, it's weird, but.
Does that depend on interest rates or whatever?
It depends on the overall marketplace, mm-hmm. but that limit goes up almost every year.
Yeah.
And I don't know why this area is 453. The mm-hmm. Keys are 529,000. There's areas of the country that are 625,000. But this area specifically is 453,100.
Interesting. Boca now, being this area.
Really all the Tri-County area.
The Tri-County area.
Yeah. FHA lending it's a misnomer that it's only for first-time buyers. It's for anybody, really.
Yeah.
It tends to be one that first-time buyers lean towards because mm-hmm. it has a very liberal set of guidelines towards credit and debt to income. So maybe your lower income earners that want to get into a place because they know their income's going to be going up, or maybe someone who had some credit challenges in the past. It's a great loan to start because you get a great fixed rate with a low down payment, and then you can always work towards a conventional mortgage at some point. So it's a great way to get into a home for a low rate, liberal
it's good
qualifying.
For millennials.
Yeah, so the FHA product has become more expensive over the years. I think during the housing meltdown, 10 however many years ago, that product was abused quite a bit, and so there was a lot of default on it. And so over time, as the government has looked at those performance rates, they've raised the costs of the FHA. So a lot of times you'll look at maybe a 3.5% down FHA loan versus a 5% down conventional loan, and because of the carrying cost, the conventional loan is the better option. So an FHA loan, specifically the PMI on an FHA loan, can be really expensive over time. PMI, private mortgage interest.
PMI.
Private mortgage insurance. So whenever someone doesn't put down 20%,
it's private mortgage interest.
They need PMI.
Yeah, that's the interest on the mortgage.
It's a insurance that protects a lender against default.
Right.
Yeah. So
insurance on the mortgage.
Mortgage insurance.
Yes.
Yeah.
Right.
So basically, the government charges people up front.
Confirming for anyone watching that wasn't sure what PMI was.
Yeah. So PMI, by definition, is for anyone who is not putting down 20%. It's a monthly fee. The FHA charges up front and a monthly fee. But generally, what you see now, most FHA deals are 3.5% down purchases.
Right.
Okay, and so they will allow for the lowest credit scores to qualify. At cross country, we don't have, I think 530 is the lowest score we'll do with 10% down between 530 and 580. We're doing one right now with no credit scores.
Really?
It's pretty interesting, yeah. It's a manual underwrite. They've owned a house before. They've got some strength as a borrower, and so we're making the loan. We pre-underwrote the file. We got an upfront approval, and so now these people who otherwise wouldn't have been able to buy are getting a great mortgage.
With that
3.5% down FHA loan.
That's
with no
awesome.
credit scores.
Yeah.
Pretty cool.
So anyone that doesn't have great credit, you can still buy a house.
Yeah, the FHA is great for that.
And low down payment. I think what I'm finding with millennials and people my age in their 20s is that some of us didn't really save for a down payment.
Sure.
So I think that's one of the other big issues we're finding, but with the low down payments, it's easier to save. Because when you're renting and you put those 3 months up front, that could be your 3.5 down.
Yeah, it can be hard to save towards a down payment. With a 30-year term, it makes the debt service usually similar, hopefully a little less than rent.
Right.
But with a 3.5% down FHA or even a 3% down conventional, you're right that it should
equal the same amount as your
security
security deposit first last.
Agreed.
Yeah, I know a lot of people my age have started realizing that and buying instead of renting.
Important too is any of those products. So conventional loans or FHA loans allow for 100% of the money to come from a gift.
Right.
So we see a lot of that.
Gifted by our parents.
Gifted by our parents.
The down payment.
Yeah. And the closing costs.
Oh, really?
Truly, on an FHA loan and a conventional mortgage, it can be 100% gift funds.
It's funny because even my dad is like, "Why are you renting? Why don't you buy something? You're wasting your money." And I'm like, "I know, help me, please."
No, it's subjective. There's no one size fits all solution. You have to know as a young person that you want to be in a certain area for an amount of time before you commit to it.
Right. I've noticed that trend as well. Some people move every few years, but I think as millennials, which are getting I think we're 35 or 40 something percent of the buyers right now, as we are getting older, we do want to plant our roots and stay there. So that's why I'm seeing more and more people buying. But
yeah, one of the big distinctions too, a lot of times people wind up in a conventional mortgage versus an FHA if they want a condo. So one of the things for millennials specifically, or for anyone, if you're looking for affordable housing in Boca Raton, Delray Beach,
go to a condo.
it's probably going to be a condo.
Yeah.
And FHA, I think there's 4 or 5 condos in all of Palm Beach County that can go FHA.
Oh, wow.
Yeah, it's pretty crazy. So it's limiting.
I never even thought of that.
Yeah, and so that may have someone who otherwise should be in an FHA loan in a conventional mortgage, right? So it's really important.
Yeah.
One of the things I tell all realtors and all clients is if they're looking for, let's say, a townhome, or if it's an FHA loan, to make sure that they look at the legal description on the property. Because if it says the word condo or any derivative of the word condo, like C-O-N-D, and maybe the O isn't there or it's redacted, that's a condo.
Yeah.
And aesthetically, like, you can look at a townhouse, it is a townhouse, but it's legally zoned as a condo. And so for a mortgage, it's going to default to the condo. And so then you have to go conventional versus FHA. So you have to always, double check.
That makes sense.
Yeah,
So.
and you can't rely on the listing agents because a lot of listings say they'll accept FHA, and it's not an FHA approved condo.
Right. That is true.
Fun fact.
Yeah.
Yeah.
Always check the property on Papa. All right, so we were talking about FHA if you don't have the best credit or you're just building up your credit, but if you want to build up your credit and you're looking for conventional or maybe not FHA, should you wait and try to fix it, or should you apply and try to get pre-qualified? And if you do try to get pre-qualified and you don't get qualified, does that affect your credit? Right,
those are great questions. So, depending on someone's time frame, like maybe if their lease isn't for a year or for 9 months, that would impact how quickly we move on things. I always think it's a good idea to look at things up front, unless somebody tells me that they just recently paid stuff off, so we're just waiting for it to update, then I would wait until it updates.
That makes sense.
But if they haven't done it yet, on our side, what we do is we look at credit, and then we have a program that's a simulator. And it's we can put in the desired score that we want. So like, let's say someone's at a 590 and they really need to be at a 620 to get the best type of financing. What's that?
We have one person watching.
Oh. And let's say they want to get to a 620. Then we can put that into the simulator, and it'll say you need this much money to pay down these 2 accounts, or maybe you need to get this collection deleted to get to that score. So we can put in how much money the person has available to commit to fixing credit, and then it'll say what the best use of those funds are and what the score will be. So it's great.
That is
it's an awesome
good.
program.
Yeah.
Super helpful.
So
go ahead.
Okay.
Yeah. So the type of loan that someone's getting, really determines what score they need, but. We do that up front. Conventional mortgages are much more credit score driven than FHA or VA.
Okay, that makes sense.
And so the way conventional loans are scored or priced is the loans get less expensive or more expensive depending on a combination of credit score and down payment. So in other words, the lower the down payment and the lower the score, the worse the pricing is. So you can offset a credit score by putting down more money.
Just like a car.
Similar. Sure. Same concept. It's risk-based. It's all risk-based. Where FHA and VA are not like that.
Yeah.
We get people the same interest rates with 750 credit scores on government loans as we do with a 620.
Okay.
So they're not punitive. They're great. They're government-backed loans.
Right. So it makes sense.
Yeah. Did I miss any of those? There was a great
questions. The one other question was, like, if you're qualifying, like, let's say you qualify for something and you don't qualify.
Sure. Does it hurt your score?
Does it hurt your score?
So if we run credit, generally that credit score is good for up to 120 days if you go shop.
Yeah.
The credit bureau, so the better way to answer that would be if someone just had their credit score run, because this happens all the time, and they're nervous about us running it. So if somebody had a credit score run by another mortgage company, then they have up to 30 days to have other mortgage companies run it with pulling the same information.
Right.
That is not the same for cars. It only works for mortgages.
Okay.
Okay, because
so you
otherwise...
have 30 days and it won't affect your credit in that 30 days.
Correct. And the reason for that is they don't want to discourage people from shopping and getting taken advantage of. Oftentimes, though, I'll run people's credit and they just went car shopping. and they'll have 20 different banks that look at this. Yeah, that's bad.
Yeah,
so I usually, we have disclosures we send out, and a lot of people in my office will have email signatures that say, do not buy anything.
Yeah.
Do not car shop.
Yeah.
It happens.
Yeah, I bet. People are
Yes.
like, new car, new house,
Right.
new baby,
New furniture.
new furniture.
Right.
Yeah. So I guess the last question I have for you, which kind of discussed a little, back to like new home buyers, maybe even millennials, are there any good deals for first-time home buyers? Or I've heard, I don't know if it's true, but like if you buy a fixer-upper, sometimes they help you finance that. And how little can you put down for a new home buyer? I mean, we talked about 3.5%, but is that the straight minimum?
It's not the straight minimum. The guidelines for conventional mortgages require 3% down for first-time buyers. FHA is 3.5%. There are some down payment assistance programs out there. Typically, my advice to first-time buyers is if they can come up with their own down payment through a gift or otherwise, it's going to be their best deal. Because the down payment assistance programs, you have to qualify for them. They typically go to the neediest of folks, or there's some income caps on them. And oftentimes the first mortgage is more expensive when you use the down payment assistance for the down payment. And so, there's no free lunch, right? It's
Hey, Dave. Our broker Dave Cyril is watching.
Big brother. So the down payment assistance programs can sometimes have a negative impact. And they can slow down the loan process if you're in a hurry. But there's one through the Florida bond is $10,000. That's a great program for people that need it. As far as people who have the down payment, if they have great credit, that 3% down conventional mortgage program is awesome. We do a lot of those as an alternative to FHA because they're less expensive if you have good credit. There are renovation programs. There's a conventional renovation program and an FHA renovation program.
That's really cool.
So if you buy a house but just need some love,
you
can do that. You can finance some of the upgrades,
That's awesome.
some of the reno.
And there's usually a max, I would assume.
There's a max. Conventional loans, you can do up to 50% of the as completed value in reno, which is a lot. If you buy a $300,000 house, you could do $150,000 in reno.
Oh wow.
Yeah. So FHA is a little more restricted. There's a couple different variations of the FHA program. But
I'm assuming if they're financing those reno, that goes into your mortgage
goes
payments.
into the mortgage. That's right.
So you're paying it with your mortgage payments.
Correct. Yeah. So we do some of those. There's not a ton of that industry-wide. There's not. We do them when people need them. We do them. They are logistically. There's some extra steps involved in those because you need to have your plans done, and
you need to have like all the homework done.
There's a lot of stuff that goes on. It's an engaged process, so it's
Yeah.
not for every borrower,
Right.
Because it does take some organization and some diligence. But people get through them. We close them, and they're great when needed.
That's
it's a great
awesome.
product.
Yeah. It seems like all of these loans are really awesome for new home buyers, experienced home buyers.
Sure.
But is there anything else you want to tell our people? We're gonna be back next week with some more questions, but that's about everything. We have to come to this side, Dave, and join our live video broadcast.
This is like coffee. This is like friends.
It is like
Yeah,
friends.
yeah, we're just hanging out.
Just hanging out.
Yeah, we're cross-country conversations.
Right.
Well, we did have a conversation. Didn't we have
Let's get
I
you.
think my wife Samantha asked you if a child of someone who served the military would be eligible for VA benefits.
Correct. Yeah, the child of the veteran would not be able to get a VA mortgage on their own. A lot of the financial institutions that service
There we go.
military
Hey,
vets.
everybody.
Yeah, we weren't that close to each other. But a lot of the financial institutions that service veterans will still extend those benefits to the family of. So like USAA, you can use their insurance products, their banking products. If you're family, if you're
You just can't get a loan through the
you just can't
VA.
get a mortgage.
Right.
You don't have their entitlements.
Okay.
Yeah.
What
Spouse does. Surviving spouse will,
Okay.
especially if it's combat related. How they die.
What So what new did you speak about any new programs or?
We talked about a lot of first-time buyer stuff. We
Yeah.
talked about really just kind of dispelled some of the bad info, and we talked about some of the low down payment conventional products, FHA products. We talked about some down payment assistance, best ways to get pre-approved, some of the minimum
Yeah,
criteria.
we're going to talk about different topics, I think, every week. If people watching this have ideas and you have questions that you would like to answer, we'll definitely be answering them in the weeks coming. So this was just...
Just real quickly, I think the reason why you use Craig and Rich is, I mean, there are many reasons, but the main reason why I use them is for leverage. I know that if they mess something up, I can go. But no, I mean they do such a good job that I know I have a control over the transaction, and control over this transaction with so many, with the percentage of deals falling through has gone like through the roof. And the more people, more good people that you can align yourself with, people that know their stuff, that knows not going to lead you down the wrong path, the less likely that you are going to have a deal die. And, I can't tell you, usually what happens is, you align yourself with a mortgage person, and, they may have a box. And if you're not fitting that box, they don't know what to do. They're still going to tell them, oh yeah, we're good, we're good, we're good. And then all of a sudden they're going to call you, hey Craig, they denied their mortgage. Can you look at this? And then Craig's got to scurry around and close in 8 to 10 days, and then they go back to this other mortgage person, and it's like, what are you doing? Why wouldn't you just stay with or support a mortgage person that is going to help you out?
Give my wallet right now. I say Alex Corzo, hope she's watching. We have one today. We got cleared to close in 7 or 8 days that another lender had for 6 weweeks, and we saved the guy half a point in interest.
That's awesome.
And we got it cleared to close.
That's awesome.
I mean, there's stories like that all the time.
Realtor miracle.
Yeah, we get the paddles out. Shocking. But there's also value in saying no.
Yeah.
Sure.
Like, there's tremendous value for our real estate partners in us saying, this is a dead end, this is a hard stop, this deal does not work. And I'm not scared to do that, because you guys know, if it works, I'm going to find a way to make it work.
Yeah.
If there's any hope there, that is the last phone call that I'm going to make, is telling you that there's no shot here. But there's also tremendous value in that if we do it on the front end.
Yeah.
There's value in having, and the key word is trusted. There's value in having a trusted partner where I can go to you and say, hey, can you look this over? I don't know if this is going to work, not work, or whatever. And if I know that, because in the 10 or 12 years I've known Rich, and the 5 years that I've known you, you have never ever said that you can do something and not close. Yeah. So the value of that, I mean, can you go to other lenders, and let's be honest, can you go to other lenders and say, you know what, can you pay for my marketing, $500, $600, $700 a month? Yeah, you could say that, but how much are you losing by using that lender? Yeah. You're gaining $500, $600. Like, you're losing 2 or 3 deals a year that is 3 times the amount of that marketing. So, I mean, listen, obviously I'm a big supporter, and I think that you guys do a great job, and I think this should be a weekly occurrence.
Yeah, we're definitely going to keep this going. Absolutely. I feel like we're on a radio show. We're all like The View in the morning, like chit-chatting, talking about the new mortgage trends and what's going on. So if anyone has ideas or anyone wants to know something, just comment below, and we'll be sure to get all your questions asked in the coming weeks and find new topics.
One last question.
Okay.
So did you discuss the rates at all?
We didn't go over rates.
Get there yet. Yeah.
But as a general, rates have been going up since January.
Right.
They've kind of leveled off over the last few weeks, plus or minus 4.5 on 30-year, plus or minus 4 on a 15-year. So they're not starting with 3s anymore.
Okay.
Maybe some jumbo arms or, are starting with the 3, but the stuff that people are getting day in and day out, the conventional fixed, the jumbo fixed, so it's going to be between 4 and 4.5.
4 and 4.5. So let's just give a quick scenario so people understand. 680 credit score, 30-year fixed, primary residence, conventional loan, in and around 4.5, 4 3/8. 680
credit score conventional loan is going to be just above 4.5.
So
probably be closer to 4 5/8, 4.75.
Okay.
740 credit score, 20% down conventional is 4 3/8, and everything in between.
Okay. Okay, great.
Cool.
And jumbo 30 years, 4.375.
Okay.
Jumbos tend to be about an inch lower.
Now, the jumbo are not fixed, or they
Jumbo
are
are fixed.
adjustable? They're fixed.
30
Okay,
year.
great.
It can be adjustable, but
Right.
most of the jumbo lending we do is 30-year fixed or 15-year fixed.
What's the
Great.
difference between like explain jumbo lending?
Jumbo
I've
by
never heard.
definition is anything bigger than $453,100.
Oh, okay.
So the
So that
Fannie
was-
Mae is, the cutoff is above 450. So jumbo loans tend to have, they're a little more paper intensive because it's not a streamlined qualification. So anything that goes through Fannie Mae or Freddie Mac, it's more of a streamlined approval process because you run it through
Right.
DU or one of these systems and it tells you what documentation you need. Jumbo loans, you generally need a little bit more documentation. They're going to really dig into people's assets, people's income. It's a little more strict to qualify, but those, to get the bigger loans, you should qualify. You know,
Right.
more of the, they want to make higher quality loans to higher quality individuals. Most people that are getting bigger loans need to be able to document that they've been making a certain amount of money for 2 years. Or conventional loans oftentimes
rule.
are one. Yeah, the rule of two.
Move right over the rule of two.
But we do a ton of jumbo lending.
Yeah.
It's nothing to be intimidated by. You know, we have people that call us that say, "Ooh, I don't want a jumbo," but it's, you know, the same. It's
Right.
a loan qualification.
Great.
Nothing to be intimidated by.
Cool. So I think we're really excited to do this again next week. So
Yeah.
we hope everyone tunes in again.
Didn't mean to steal your thunder.
No, I
You
keep
know,
going.
listen
Oh,
to
okay.
that. Listen
Come
to
join
it.
us.
You know, I think you should tune in next week because I think Craig is going to talk about how to turn a conventional contract into a cash contract, even though you have financing. Well, I think that's a big one. He's taught me a couple of things and a couple tricks that you could do before the contract, and I think you'll talk about that next week.
Yeah.
Stay tuned.
Stay tuned. Central No Cash. Thank you
Teaser.
everybody
Boom, boom, boom,
for
right?
coming and tuning in, and we can't wait to see you all next week. Bye. Live from Remax Services.